Earning more means nothing if spending grows faster. Lifestyle inflation is one of the most common financial traps people fall into as income increases. Instead of treating a raise as an opportunity to strengthen savings, many treat it as permission to upgrade their lifestyle. Every new comfort slowly absorbs the extra income. Over time, expenses rise to match earnings, leaving savings unchanged. This creates the illusion of progress without real improvement. Temporary satisfaction from upgrades quickly turns into long-term pressure. Fixed expenses reduce flexibility and limit freedom. A controlled lifestyle allows income growth to serve future goals instead of present comfort. Stability grows when spending is intentional. Stability reduces stress. Reduced stress improves confidence. Confidence supports better financial choices over time. Lifestyle control preserves options. Preserved options increase resilience. Resilience protects long-term growth. Just because credit is available doesn't mean it's affordable. Easy credit feels convenient, but often becomes a long-term burden. Loans and credit cards remove the pain of spending in the moment. Repayment, however, always carries pressure. Interest quietly increases the total amount owed. Minimum payments create false comfort while hiding the real cost. Debt begins consuming future income before it is earned. When income is already promised to debt, growth becomes impossible. Credit should support progress, not fund lifestyle. Crossing borrowing limits reduces freedom and increases dependency. Many people remain trapped for years without realizing it. Awareness limits borrowing. Control reduces pressure. Lower pressure creates space for recovery and rebuilding. Smart borrowing protects cash flow. Protected cash flow restores flexibility. Flexibility accelerates recovery. Money without direction always gets wasted. Without a clear direction, money flows without purpose. Undefined goals weaken decision-making. Weak decisions reduce efficiency. People stay busy but see no measurable progress. Saving and investing become inconsistent. Lack of clarity allows distractions to take control. Clear direction gives meaning to effort. Defined targets reduce unnecessary spending. Focus protects both time and energy. Focus also acts as a shield against financial traps. Written goals strengthen discipline. Discipline builds consistency. Consistency creates visible results. Visible results reinforce motivation. Direction turns money from chaos into a controlled system. Clear direction improves momentum. Momentum reinforces habits. Strong habits compound results. Fast money usually comes with hidden losses. Quick money schemes attract attention by promising easy success. High returns often hide high risk. Decisions driven by excitement ignore logic. Fear of missing out clouds judgment. Investing without understanding becomes gambling. Losses damage both money and confidence. Confidence takes time to rebuild. Slow and steady growth may appear boring, but it is reliable. Real wealth is built through patience and structure. Avoiding shortcuts protects capital. Awareness filters hype. Filtering limits damage. Limited damage allows long-term growth to survive and compound. Patience strengthens judgment. Strong judgment avoids traps. Avoidance preserves capital. What you don't learn will eventually cost you. Ignoring financial education is one of the most expensive traps. Playing the money game without knowing the rules almost guarantees loss. Ignorance repeats mistakes. Repeated mistakes compound damage over time. Lack of knowledge makes manipulation easy. Learning builds awareness. Awareness builds confidence. Confidence improves decision-making. Educated decisions reduce risk and increase growth potential. Knowledge protects against scams and poor strategies. Learning also reduces fear. Reduced fear encourages rational thinking. Rational thinking keeps money safe and decisions balanced. Education improves adaptability. Adaptability handles change. Change readiness protects wealth. Tomorrow's saving usually never happens. Delaying saving feels harmless but creates long-term damage. Many people plan to save after income increases. Expenses, however, rise alongside income. Saving never becomes a priority. Money always feels insufficient. Emergencies expose the weakness of this approach. Limited options force rushed decisions. Panic decisions often lead to debt. Debt consumes both money and future freedom. Early saving builds security. Security builds confidence. Confidence improves stability during pressure. Making saving a habit from the beginning prevents this trap entirely. Early habits lock discipline. Discipline ensures consistency. Consistency compounds security. Not every suggestion is meant for your situation. The internet is full of financial advice, but not all of it applies universally. Income levels differ. Responsibilities differ. Risk tolerance differs. Blindly following others creates confusion. Confusion leads to wrong actions. Wrong actions produce losses. Advice must be understood before being applied. Personal reality should guide decisions. Filtering advice protects progress. Thoughtful application reduces mistakes. Smart decision makers adapt advice instead of copying it. Adaptation improves relevance. Relevance increases effectiveness. Effectiveness protects outcomes. Protection ignored today becomes regret tomorrow. Insurance is often misunderstood because it offers no instant reward. Its purpose is protection, not profit. Unexpected events can erase years of savings overnight. Accidents, illness, or loss arrive without warning. Without insurance, recovery becomes extremely difficult. Insurance transfers risk away from personal finances. This protection preserves stability. Stability supports mental peace. Mental peace allows long-term planning. Ignoring insurance places progress under constant threat. Protection preserves continuity. Continuity reduces shock. Reduced shock sustains progress. Unused money slowly loses power. Idle cash may feel safe, but inflation steadily erodes its value. Over time, the same money buys less. Growth stops when money does not work. Safety does not require inactivity. Balance is the key. Smart planning gradually places money into productive paths. Productive money supports future stability. Idle money creates false security. False security often fails during difficult periods. Balanced deployment improves resilience. Resilience absorbs volatility. Absorption maintains stability. What you don't review will slowly collapse. Many people create financial plans but stop reviewing them. Without review, small leaks go unnoticed. Small leaks become large losses over time. Regular review maintains direction. Early correction prevents major damage. Awareness improves control. Control strengthens discipline. Disciplined money continues to work efficiently. Reviewing finances keeps progress visible. Visibility supports long-term consistency and growth. Regular reviews reinforce alignment. Alignment improves execution. Execution sustains results.